We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Pento from Pento Portfolio Strategies. How are you today, Michael?
I'm doing terrific, Tom.
Thanks for joining me again today. So I wanted to start by kind of touching on a couple of the articles that you've recently written and ask you if the most pernicious part of the bear market is ahead of us yet.
Well, of course it is. I mean, the first part of the bear market was a PE ratio correction. So just the valuations were too high and you have a drop. So the numerator was way too high. Now it's down to about 17 and a half times forward earnings. There's only one problem, Tom. The E, the denominator, is all wrong. I believe the next phase of this crash, and it is already a crash. You have like the Nasdaq's down, I think, 27%. The S&P's down some 15%. Long-term bonds are down 28%. I mean, talk about a crash in the 60-40 portfolio. But that's just the opening salvo. That's the overture. The salient, the steepest part of this toboggan ride is going to be when Wall Street has to recognize that earnings are going to go down and going down fast. And we still have predictions of earnings acceleration, earnings growth of 2023. No, earnings are going to fall due to the global recession and the most hawkish cohort of central banks we have ever seen. So the earnings are going to crash. That means not only is the earnings denominator too high, but the P in the numerator is too high. So you have to be trading at maybe 12 or 13 times much reduced earnings before this market can bottom. And I'm looking at a market bottom that maybe we could start thinking about with S&P around 3,300, maybe. And that's just an optimistic point of view.
I was speaking to somebody the other day and they were saying once we get below this 3,900 level on the S&P, as you're saying, we're looking at more like a 3,000 to 3,300, somewhere in there. So is there a reason you picked that 3,300 level, or is it based on technicals? How do you see that?
I don't do technicals. I don't rely heavily on technicals, I should say. I'm much more of a fundamental analyst. So if you look at the total market cap of equities as a percentage of GDP, right now it's around 160%. So think of the valuation of equities are 1.6 times the underlying economy. Now that level is higher than at any other time in history, from the signing of the Buttonwood Agreement all the way to the summer of 2020. And if you want to put that ratio in some kind of reconciliation or a better metric, a more fair valued ratio, you're talking about maybe 100%. So the total valuation of equity should be around 100% of the economy. That's still very rich historically. By the way, that's where it was. 103% was just prior to the start of the Great Recession, when the S&P lost 50% of its value. So, and even if you look at the Nasdaq bubble peak, it was 140% total market cap of equities to GDP. So it's still a very rich metric, but I'm going to use that as my starting point to when I think things will start to look more fairly valued. And that's, of course, in the context of a Fed that says, okay, we assent to the fact that we can no longer raise interest rates. We have to cut them. We can no longer do QT. We're going to have to go back into QE. So that ratio starts to become more favorable around S&P 3,300.
Okay. So you had mentioned long bonds earlier. And when we look at the 2 to 10 year spread, when was the last time we saw it this negative? And what is this typically an indicator of?
So the last time we saw this spread this negative was in the 80s. So the yield curve is more inverted now than at any other time in the past 40 years. Now, what does a yield curve that's inverted signify? It signifies a recession. And virtually every time this curve has been inverted, the spread between the 2-year note and the 10-year note is negative, has signified a recession. And there's a very good reason for that. It's not just it's not like saying it's a coincidence. It's not correlation. It's not just coincidental. The fact is that banks lend long, they borrow short and lend long. Well, if their borrowing costs are higher than what they can make on their loans, they stop lending money. Now, I know there's, it's very nuanced and there's other ways of making money. And, of course, the deposit rates aren't what they were in prior decades. They're not rising as quickly. But the bottom line is this: when their spread, the net interest margin of banks compresses to zero or negative. And the reason why that is because their assets are in danger. This is not a time where a bank goes out and extends, a plethora of loans to buy houses. So their book contracts, their profits contract, the money supply contracts, and that causes asset prices to contract. And that means that the economy slows even faster. And that's really, really bad for earnings.
So as you're kind of explaining, this has real world implications for, let's say, the broader economy and the average consumer, because they're pulling credit and making credit harder to attain for, let's say, the average business to get, because they're not able to make money on those loans.
The primary dealers understand that the construct is in reverse right now. I mean, it used to be for most of the time, the duration between 2003 to today, it used to be that, well, the Fed prints a lot of money and they buy assets from banks. They take away their mortgage-backed securities. They take away their treasuries. And then what does the bank do? Like during QE, what is the function? Well, the Fed says to banks, the primary dealers, I am going to buy an unlimited amount of mortgage-backed securities and bonds from your balance sheet. So they take those assets off of the primary dealer's books, and then they get credit, something called Fed credit. Well, what do you think a bank would do when they say, oh, gee, I used to have a treasury, and now I know there's an unlimited buyer, the federal government, who is indiscriminate in their buying. So they don't care the price. They don't care anything about their profit and loss. All they care about is giving us, the primary dealers, $120 billion a month and taking away our assets. What they do with those assets is obvious. If they're going to put treasury prices in a bull market, they're going to front run the Federal Reserve. So they buy more. They buy more mortgage-backed securities. They buy more treasuries with that Fed credit. And that brought interest rates, borrowing costs close to zero. And then you sit there, well, why did home prices go up 20% per annum lately?
Mm-hmm.
Why are rents up 12% nationally and in New York City up 46%? I mean, it's clearly a function of the Federal Reserve buying all these assets. It's called interest rate repression, sending these borrowing costs close to zero. And then banks have all this credit to go on a buying spree. They buy bonds, they buy treasuries, they buy mortgage-backed securities, they buy stocks, they buy everything. Because if you're going to have the cost of capital be zero, then what's the discount ratio there? What's the discount to capital? You're going to go out and buy stocks, right? So is there any wonder why the stock market on a price to sales ratio is higher today than almost at any other time in history? Why the total market cap of GDP today is higher than any other time in history prior to just post the COVID, $6 trillion of COVID pandemic related spending? No, it's no mystery. All that is in reverse, Tom. Mm-hmm. Now what we have is a Fed that's gone from 0%. Don't forget, the Federal Reserve had the Fed funds rate at 0% in March of this year, 0. And now they're going to go to 4%. They have no choice. They have to do it. I can explain why later if you want me to. They have no choice but to go to at least high 3s, low 4 by March of 23. So that's 400 basis points of rate hikes in the span of 1 year. So, Tom, that has only happened, I think, and I look back at this, it only happened twice before in history, and it has never gone from 0 to 4 in 12 months, ever. That's the fastest rate of change of a hiking policy ever. And it is also being done in conjunction with QT, quantitative tightening, times 2. It is 2 times greater than the apex, the highest point of tightening in 2019, when they were tightening at $85 billion a month. So twice the pace, I'm sorry, $45 billion a month. I correct myself, $45 billion a month in quantitative tightening. And don't forget, let us not forget that quantitative tightening and baby step rate hikes in 2018 caused the stock market to fall apart. Remember, in 2018, the Fed, they were 2.5%. They said we're going to the mid to high 3% on the Fed funds rate. And the stock market fell apart. And the Fed had a promise to stop hiking rates. They did that at the end of 2018. Then they kept on with QT for a few more months, but then by December of 2019, the repo market froze and the stock market started to unwind. And they had a promise to stop QT. Well, they had to stop that when the Fed funds rate was 1.75%. They did that. This is all prior to the breakout of COVID-19. And that's when we had a lower stock market and much less debt in the system. Much less debt in the system. So the fact that the Fed now thinks that they can get to 4% innocuously and do $95 billion a month in QT innocuously, like watching paint dry, I think is asinine. But again, Tom, they have no choice to do it because prior to COVID-19 and the $6 trillion in stimuli that they had to hand out to people, had $4.5 trillion monetized by the Fed. That's the increase in their balance sheet. Prior to that, there was no inflation. Inflation was all on Wall Street. It was all on asset prices. It wasn't in the consumer price index. But the CPI now is, very close to, it was almost 10%. Now it's in the mid 8s. But the core rate of CPI, the core rate of consumer price inflation accelerated month over month last month to a new high. Okay, a new cycle high. So the Fed is making the calculation. It's like, hey, I've been in this asinine pursuit of 2% inflation for over a decade. I couldn't get there. I finally got there, but the Fed has a very difficult time, if you haven't noticed, controlling inflation. First, it used to be 0. Okay, then they didn't like that because it wasn't good enough. Wall Street begs the Fed, hey, we need some kind of inflation to get these asset prices going. So then they assented to the fact that we'll get 2% inflation. Tried with QE, couldn't get there because all of the inflation went on into stocks and bonds and real estate. Didn't get to the main street economy, which is a good thing that it didn't hit middle class. It just hit Wall Street, and then finally it went miraculously from below 2% for many, many, many years, all the way up to double digits, very close to double digits. And on the producer prices was over double digits. And that was because of the unholy union between fiscal and monetary policy. So now the Fed has no credibility at all. So the Fed has now said that every single member of the FOMC, even Neil Kashkari, who used to be an Uber dove, now they're all saying, hey, we are going to 4%. We are getting there as fast as possible. We don't care what happens to the economy. We don't care what happens to Wall Street. We must get inflation back to 2%, and we have to get it there as fast as possible. So that's what's going to happen. I think on the way to getting inflation to 2% and on the way to getting the Fed funds rate to 4%, they're going to destroy the credit markets and wipe out the economy once again. But they're actually telling you right now that once they get to 4, they're going to stay there for a long time. I have my doubts how long they'll be able to stay there because, again, I think the credit markets freeze and cause them to do something. They have to react because if you can't float commercial paper, you can't float a junk bond. The economy just forget about a recession. It's a depression. Mm-hmm. But the thing is that they cannot pivot. Here's a note for the pivot prevaricators. All of and I hear them all day on CNBS and even Bloomberg. All day they have these guests come on saying, the Fed can't hike rates because the economy is going to slow. They have to do it to gain any credibility back, that they've lost all of it, and they have to gain some credibility back, because the worst thing they want to happen, and this is what they've said, they don't want to have another repeat of the 70s. When they see inflation start to come down, they pivot, and then it goes right back up. This is going to be, in my opinion, one of the deepest recessions we have ever seen, and one of the sharpest declines in asset prices that we have ever seen.
So, Michael, we're talking a lot about, let's say, the indicators that the Fed is using, whether it's CPI or jobs numbers, whatever it is. Is it possible that some of these indicators that they're relying on are misleading them? If we combine jobs numbers with overall labor participation rate, does this paint a picture of more people needing to get second or third jobs? And
yes.
Does this nuance not matter to the decision-making process of the Fed?
Listen, if anybody still believes that Powell and company have any idea or any prescient knowledge of what inflation is, what causes it, what's really going on with the economy, they have to be disabused of that. They really have no clue. Remember, this is the same group of people who told you that QT was going to be like watching paint dry. This is the same group of people who told you that inflation was transitory. They have no clue. I mean, if you look at what's going on in the labor market, and if you look at the household survey, not the establishment survey, there's hardly any jobs created this year at all. And the household survey usually leads the establishment survey. So let me be very clear. The economy is weak. The first half of 2022 was a recession. We're going to get a very small positive Q3 print, mostly due to a massive inventory build. When you build inventory, it's accretive to GDP. There's a 22.5% build in inventory year over year, because remember, corporations and suppliers couldn't get anything during COVID, so they over-ordered. Their inventory to sales ratio has shot up very significantly. So they're loaded with things. When you order something as a business, it's accretive to GDP. But when you draw down inventories, it's a subtraction from GDP. Mm-hmm. You subtract that from consumption because you already counted it when you build the inventory. So Q4 is going to be negative. So most of this year, in fact, year over year should be a negative GDP print. And nominal GDP is coming down very quickly, not just real GDP, but nominal GDP is coming down because inflation is coming down. The second derivative of inflation is coming down, albeit not as fast as the pivot prevaricators would like, as I like to call them, because 40% of core CPI is housing related. It's owner's equivalent rent. And those rents are still going higher, not coming down. And the Fed knows this now. The Fed knows that in the pursuit of this ungodly 2% inflation, I don't know how that got in their minds, that the economy can't function properly unless we're destroying the purchasing power of consumers by a 2% annual rate. That's what they thought. Okay, but on the way of creating 2% inflation, what they ended up doing was creating a real homelessness problem, because people can't afford their rent, they can't pay for medicine, and they can't heat their houses. And that's the shame that the Fed understands. It's an embarrassment. It's a massive embarrassment to the Federal Reserve. So they're going to do whatever they can, whatever they have to do to bring inflation back down. And they will destroy the economy and the markets, and that includes real estate, fixed income, and equities.
Yeah, it's such a bleak outlook. But again, as you say, they've really telegraphed what they want to do here. And, when we hear about terms like, let's say, the Build Back Better bill or the Inflation Reduction Act, do you look at the wording of these types of bills as an insult to people's intelligence, Michael?
I mean, this is the government. This is the feckless nature of government. I mean, the way they fight inflation is by giving people money. I mean, this is okay, so how college tuition is too expensive. So what's the answer from government? Is the answer from government to bring more market-based forces into college, college costs? No. Increase the supply of colleges? No. What the government does is, hey, it costs too much to go to college, so I'm going to give people more money to make it affordable. Well, this is the same thing they're doing now in the United Kingdom. Energy prices are too high, so I'm going to raise a bunch of debt and hand people a check. So all you're doing is creating more demand for the commodity or for the service and the educational services, and which causes the prices to rise. There's nothing to deal with supply, and it makes the whole thing more expensive. And by calling this act the Inflation Reduction Act and hiring an army of IRS agents to go after people who don't pay their fair share, that's some way fighting inflation. It's absolutely ridiculous. The subsidies do not fight inflation. Market forces, real market forces, fight inflation. So what we need to do is increase the supply of goods and services. And to do that, you have to create productivity. And only productivity, that is the genuine fight against inflation, is to increase productivity. And I will tell you, productivity in Q1 of this year was minus 4.6%. Productivity in Q2 was minus 4.1%. So, handing money to people and telling them they don't have to work, and if they go outside, they're going to catch a disease that's going to kill them. That is the antithesis of how to produce a productive nation. So what we've done is we've killed productivity. Our population growth labor force growth is 0.5%. That's the long-term trend. So long-term GDP growth, instead of being where it should be, low to mid single digits, it's now negative.
You mentioned the growth of the IRS. Do you think this could be because the government recognizes what falling tax receipts could mean? And how would falling tax receipts affect the federal government?
Well, falling tax receipts are going to happen. That's what always happens in a recession. Mm-hmm. And, the debt service payments on the national debt are skyrocketing. They're close to 15% of GDP right now, 15% of income to the government. So, the idea that the Fed, and right now the Fed funds rate is 2.3%. The idea that it can go to 4% and the 10-year note can go to 5%, the debt service payments are going to skyrocket. And I'll tell you this, if they didn't fight inflation, let's just take it to Japan for a second. If Japan didn't cap interest rates at 0.25%, what do you think their debt service costs would be on a quadrillion yen in debt? And their interest rates on a free market basis would be double digits because it's an insolvent nation. Well, where do you think if inflation in the United States is 8% or thereabouts, and legitimately, if you counted it right, is closer to 17%, down from 20%. If inflation is 17% and you have the national debt, which has absolutely skyrocketed to the highest ratio it's ever been outside of World War II, right after World War II, what do you think a fair interest payment would be on that? It wouldn't be 2 or 3%. The interest costs would be closer to double digits. So, but that would make us an insolvent nation if we had to pay a legitimate interest on our debt. So this is a very complicated and intricate trap. There is no easy answer. Either you fight inflation, bring interest rates down, cause a recession and a depression. That causes the receipts to the government to crash, which means that interest rates are going to skyrocket anyway for a short period of time at least. But then that's the real way to fix this. At the end of all this, you'll have restructuring, you'll have defaults, reorganization of debt, and then you can come out of this on with some sense of reality, on the other side. Mm-hmm. The other tactic to take is, hey, let's just keep on. I even heard this today before this interview. I had this guy come on who's talking about how the Fed can't raise interest rates, can't fight inflation because it'll destroy the economy. Well, what do you think is going to happen? What do you think would happen if the Fed came out and said, okay, you're right. We cannot fight inflation because the unemployment rate might rise a little bit. Well, what do you think would happen to our dollar? Where do you think long-term rates would go? Duration bonds would skyrocket. who would buy all of this debt, knowing that we admitted that the U.S. government admitted it could never control inflation, has no power at all or any will or desire to do so. So they are trapped. This is a very big problem. And for people who sit there and believe, well, you just dollar cost average, you just buy and hold stocks and everything's going to be fine. Well, maybe that was true in 1960, when we had a real economy. But ever since the year 2000, we don't have does anybody really, Tom, go out and start making a calculation on what stocks to buy based on a discount to cash flow? Nobody does that anymore. Nobody with a half a brain does that anymore. You know what they do now?
Chase momentum.
They read the tea leaves from every utterance of Jerome Powell. All they really care about is, all they really want to know, and it's a fact. Just look at the direction of stocks based upon every utterance that comes out of Jerome Powell's mouth. If he came out tomorrow and said inflation is coming down quickly and I don't think we have to do any more rate hikes, the dollar would crash and stocks would go up several thousand points. But if he comes out and continues to say, hey, we've said it and we're going to do it. We are going to raise interest rates to 4% and we will continue to keep them there for a long time until inflation is vanquished. Then the stock market is going to continue in this incipient but still brutal bear market. And I want to just make this point very clear. I said it before. I want to make sure I hammer this home. In March of this year, it was 0% on the Fed funds rate. It's going to be 4% by March of 23. In other words, the negative effects from the rate hikes have yet to really begun to be felt. Mm-hmm. The Fed's balance sheet is still at $8.9 trillion. It's very close to $8.9 trillion. It's only down about $100 billion from the top. The Fed says they're going to drain $95 billion a month for 2 to 2.5 years. That hasn't even begun to be felt. So there are times, and this is my whole predicate of my inflation, deflation, and economic cycle model. There are times when you want to underweight this asset and overweight that asset. Mm-hmm. There are times, by the way, Tom, if you look at Japan, they peaked in 89. If you look at China, their Shanghai index peaked in 2007. So the idea, and even in this country, there are times when 15 years have gone by where you have made no money at all. So there are times, money managers are out there. Earn your money. Don't take people's money, put it in a 60-40 basket, and tell people that you can't time the market. So just go out there and raise some more assets because eventually things will be great. That used to be true. It is definitely no longer the case.
Mm-hmm. And to your point, Michael, I think the way the math works out, if we go from 0 to 4%, the amount of money that needs to service that debt every year would be something on the order of $1.2 trillion because it's $300 billion for every 100 basis point hike. So that's an absolutely untenable situation, it seems like. But you wrote recently that we could see the real peak of inflation during a recession. So why is that?
Inflation always peaks during a recession. Almost always the case. Here it is. So we had stagflation in the 70s. We could have that again on the other side of this next coming recession/depression that I see happening. But here's my point that I was trying to make. The cheerleaders, the shills, the buy people on Wall Street, we're all telling you, hey, inflation has peaked and that's a sign to buy stocks. Well, let me just remind you, in 2008, let's just look at the summer of 2008. Oil peaked at like $145 a barrel, and then it started crashing. In August of 2008, Tom, was that the peak of inflation? I'll answer my own question. Yeah, it was the peak of inflation. Tom, was it a good idea to buy stocks in August of 2008 because inflation had peaked? No. Inflation sometimes peaks because the demand is gone. And same thing in 2001, inflation peaked in the very early 2000s. Was that a very good time to buy stocks because inflation had peaked? No. was a very bad time to buy stocks. It was even bad to buy stocks just because the Fed started cutting rates. The Fed started cutting rates in the summer of 2007. Was that a very good time to buy stocks? Rates peaked in 2007. The Fed funds rate peaked in 2007. Market rates peaked and inflation peaked. All a very bad sign because it's a sign of recession. So if you have inflation peaking while growth is good or accelerating, then that's a very good sign. And even if you have inflation peaking and growth is crashing, in the long term, it's a wonderful sign. But in the short term, it's a really bad idea to go out and buy stocks because recessions and depressions are never a good time to buy stocks, even if the price, the cost of goods are going down.
So I'd like to get a little bit about how you're positioning yourself in this particular environment. As you said, there's no set it and forget it way to be doing this. So what are the four horsemen of the economic apocalypse, as you call them?
So the four horsemen of the economic apocalypse are cash, U.S. sovereign debt, U.S. treasuries, the U.S. dollar, and shorts. If you own those four things, you will probably not lose, because I can't guarantee anything, but you will probably not lose money in a bear market, what I call sector one, which is a second derivative plunge in growth and inflation, which is where we are now. My calculations, my math shows me that. But you can even make money in that environment because normally in that environment, you'll see, of course, U.S. treasuries do very well, price up, yield down. The cash you can't lose money in. The U.S. dollar, which has been wonderful since the duration that we've owned it, it's been really good since March of 22. So it's been wonderful. And also shorts, of course, when the market goes down, shorts go up. So if you own those things, at the very least, might be down a couple of percent if the bond portion of that portfolio isn't working, but you won't be down 25% like everybody else. Mm-hmm. And when all four of those horses are pulling in the chariot in the same direction, you actually are, most likely going to make money while everybody else is getting killed. Mm-hmm. Because everything goes to a correlation of one, except for those four things. Even gold doesn't do very well when you see a liquidity crisis, which I think is very clear that we're headed towards a liquidity crisis here once again.
Yeah, I'd like to touch on gold in a second, but when you talk about the shorts that you're placing in this market, are you using a specific vehicle? Are you shorting specific stocks, or is it more of a broad approach?
So in my portfolio, I don't use leverage, margin, or options. We normally have very wealthy people here who are very interested in not being a cowboy and not going crazy with options that expire worthless or losing an unlimited amount of money shorting a stock. So I use inverse ETFs on the margin, but primarily I go long ETFs that go up in price when their holdings go down. So they do the shorting in a margin account. I just own them outright in a regular account.
And just to get back to the gold idea, what is the scenario where you're going to get back to adding to, let's say, your gold position and your miners position? Is it more so when we see an actual pivot from the Fed rather than this backing off of super or the 75 basis point hawkish rate hikes that we've seen?
Tom, that's the new dovishness. I love, Wall Street. Here's the problem, Tom. Most of the wirehouses, I call them the deep state of Wall Street, they can't short stocks. They can't go into cash. They're obligated to hold stocks in a certain percentage. And maybe, if they go to 5% cash, they get like a call from their compliance department. Oh my gosh, why are you charging fees on 5% cash? Mm-hmm. And they end up, and then they are doing their clients a big disservice by being fully invested in FANG and whatever, and they get crushed. So what you need to do in this situation is have the flexibility to go long stocks, bonds, currencies, commodities according to the second derivative of growth and inflation. If you can do that, you can end up saving your clients a lot of grief. So did I answer your question or did I not?
Maybe let's just make it a little bit more clear. At what point do you think?
Oh, I'm sorry. The reason why we were very long gold about a year ago, and then we sold almost all of it. Right now we're 5% long physical gold in the portfolio with no miners. And the reason is clear. Gold doesn't like rising real interest rates. So what you see now, and this is exactly what's happening now. Nominal rates are rising. I don't think anybody can doubt that, right? Nominal interest rates are rising. And at the same time, we see on the second derivative basis, disinflation. So inflation we still have inflation, but it's inflation, the rate of change of inflation is falling. So we went from 8.5, 8.6, 9.1, now we're down to 8.3 on inflation. So when you have those two things happening, real interest rates are rising. So you're subtracting less from the nominal interest rate. Do you follow me? Okay. That's a rise in real interest rates, which is what gold hates the worst. Now, this is what gold, and I am not giving up on gold. I'm a gold bug. I love gold. I can't wait to get heavily back into gold. Most of my clients, they love gold too, but they understand that gold can kill you. I mean, if you've been long gold this past year, especially the miners, you're down, 25% in the miners, and it's something I just never want to be down that much in any particular asset class if I could avoid it. So what's going to happen in 2023, I believe, is the economic growth is going to slow so substantially that it causes the credit markets to freeze. You can't float commercial paper. You can't float a junk bond. The repo market freezes. Banks start tapping that repo facility that the Fed created. And just because a primary deal is tapping the repo facility doesn't mean anything about growth. The economy's not booming because banks can't lend to each other. They have to borrow money from the Fed. There's not a recipe for growth to boom. So the credit markets freeze once again. And that means the Fed's going to have to start to lower interest rates and probably reliquify the banking system again by stopping QT and increasing its balance sheet. When that happens, you're going to see the dollar tank. You're going to see nominal interest rates start to fall and inflation start to tick higher. And when nominal interest rates fall and that subtraction is greater because of you subtract inflation, it's rocket fuel for gold. So if you get a falling real interest rate and a falling currency, which is I think you will get sometime in 23, I want to model that, anticipate that, and jump all over it. And that's what I plan.
Excellent, Michael. Well, I want to be respectful of your time here today. I really appreciate you walking us through how you see everything that's going on right now. Of course, all of your info is available at pentoport.com. You do a weekly podcast, is that right?
I do. Reality check. It's $50 a year. You get a 5-week free trial. You get my point of view on things and data that I compile. It's all very accurate, all very salient and necessary for you to navigate these very difficult waters.
Absolutely. And, I appreciate you giving us your nuance on gold. Just because we have gold in the name of the show doesn't mean that we should always be, religious zealots about that particular asset class. I think it's the best way to look at things is accurately and when they're going to perform and how to help position ourselves and learn as much as we can about it.
No, credit to you for saying that, because in the end of the day, I'm trying to sell my services. You're trying to sell this, and so everybody's trying to sell a newsletter. Good people who care about being great and want to do the best for their customers or for their audience. So let's speak the truth. Wouldn't it be great if 4 months from now I came on Palisade Radio and said, hey, this guy was negative on gold. He was correct, but now he's positive on gold. Doesn't that advice mean a lot more than people like, I won't mention names, but people who appear on the mainstream financial media who are always bullish, no matter what's happening. And they tell you at every time, like they told you on Monday, or when the market crashed, they tell you things like, well, I bought stocks yesterday, but last week you told me you were 97% in stocks. So what did you buy? With what money?
Mm-hmm.
Have some credibility. And I'm proud and happy to be associated with someone who has gold in their name, but cares more about their audience being successful than just always being bullish on anything. So credit to you. Thank you.
Well, thank you, Michael. And yeah, I had a conversation like that the other day. And hopefully, like you say, we can come back in 4 months and say, here's where we reposition ourselves and it's go time.
I look forward to that, Tom.
Awesome. All right, Michael, thanks so much for your time today.
Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.